welcome to another explainer. Today, we're taking a massive deep dive into the absolute engine of our economy. We are unpacking the banking system in India. I'm talking history, core function, recent amendments, and the sheer power of the central bank. Basically, this is everything you need to know about how the money in your pocket actually works. Okay, let's just glance at our roadmap for today. First, the birth of banking. Then, how banks actually create money. Third, we'll look at the history of Indian banks. Fourth, the immense power of the RBI. Fifth, controlling the money supply. And finally, reforms and what the future holds. Let's get right into it. Now, here is a pretty wild thought. Banks don't just store your cash. They literally create money out of thin air. Economist Culbertson hit the nail on the head here. A bank isn't just some giant vault where your money sits around collecting dust. Every single time they grant a short-term loan to a business or a person, they're actively expanding the total supply of money in the economy. I know, it sounds a bit like magic or maybe even a little suspicious, but it's actually the bedrock of our entire financial system. So, Section 1, the birth of banking. To understand how that magic works, we've got to meet Lala. Let's imagine a small village where folks are trading with heavy, risky gold. To keep it safe, they deposit it with Lala, the goldsmith. Lala gives them paper receipts in return. Well, pretty soon, the villagers realize, hey, it's way easier to just trade these paper receipts for wheat or shoes instead of lugging physical gold around everywhere. Then, Lala has this huge aha moment. He realizes nobody actually comes back to withdraw their gold all at once. So he starts lending out a chunk of that idle gold to other people, issuing even more paper receipts. He only needs a tiny fraction of the physical gold in reserve to handle daily withdrawals. And just like that, we have the exact foundation of modern fractional reserve banking. New deposits and loans expand the money supply way beyond the original gold. All right, Section 2, how banks create money. Let's see how Lala's little village trick translates into the actual math that global banks use today. The crucial point here is the money multiplier. A bank's ability to turn deposits into massive pools of loans is strictly determined by this exact formula, which is governed by the cash reserve ratio, or CRR. Because banks know you won't need all your cash tomorrow, the law only requires them to keep a fraction in reserve. Say the legal CRR is 20%. The money multiplier is 1 divided by 0.2, which equals 5. So think about it like this. You deposit 100 rupees. The bank keeps 20 and lends out 80. That 80 gets spent, deposited into another bank, and they lend out a portion of that. Through this crazy compounding cycle of lending and depositing, your initial 100 rupees expands into 500 rupees circulating in the broader economy. Pretty mind-blowing, right? You can really think of banks as the ultimate economic matchmakers. Their primary job is taking your idle savings and handing them over to an entrepreneur who wants to build a factory or expand a small business. That capital formation is absolutely essential for economic growth. But beyond that main credit engine, they obviously handle the secondary functions we rely on every single day. Clearing checks, providing safe deposit lockers, and just managing the whole convenience of internet banking. But how did this massive engine get built in India? And who is actually steering the ship? That brings us to Section 3, History of Indian Banks. This timeline condenses over 200 years of history, starting way back in 1770 under British rule with the Bank of Hindustan. Over time, regional presidency banks merged to form the Imperial Bank, which eventually became the State Bank of India in 1955. But the real game changers were the massive waves of nationalization in 1969 and 1980. The government nationalized a total of 20 major private banks. And why was that such a huge deal? Well, before 1969, banks mostly served wealthy industrialists in cities, basically ignoring farmers and rural businesses. Nationalization was a massive push to force credit into the hands of the rural population, making sure banking focused on broad social welfare and agriculture, rather than just private monopolies. So, we've seen the engine, now let's meet the driver, who comes equipped with all the brakes and accelerators. Section 4, the power of RBI. The Reserve Bank of India holds absolute macroeconomic power. Fully nationalized in 1949, they are the apex institution. They are the only ones allowed to issue currency notes. They act as the banker to both central and state governments, and they manage all our foreign exchange reserves. But maybe their most critical job? They are the lender of last resort. Basically, if a commercial bank faces a sudden panic or a bank run and they run out of funds, they could collapse and take everyone's savings down with them. The RBI steps in as the ultimate safety net, throwing them a lifeline of emergency funds to prevent a total economic meltdown. It's all about maintaining public trust. Okay, Section 5, controlling the money supply. Let's dig into exactly how the RBI uses its tools to speed up or slow down the economy. We talked about the math of the cash reserve ratio earlier, but here's the formal definition. It's a legally required percentage of deposits that a commercial bank absolutely must keep parked as cash with the RBI. So let's say prices are skyrocketing and inflation is getting out of control. The RBI needs to cool things down, right? To hit the brakes, they just increase this CRR. Banks are forced to park more cash with the RBI, which instantly shrinks the funds they have available to lend out. The multiplier effect shrinks, credit gets scarce, and the whole economy cools off. Now, all of this control only works because of the specific nature of our currency, fiat money. Fiat money has value for one simple reason. The government declares it legal tender. You can't legally refuse it. To control exactly how much of this high-powered money is floating around, the RBI uses open market operations. Think of it like a giant tap. The RBI literally buys and sells government bonds in the open market. When they want to flood the economy with cash, they turn the top on. They buy bonds and hand over cash. When they want to dry things up, they turn the top off by selling bonds, pulling all that money right back out of circulation. Then we have the repo and reverse repo rates, which directly impact you and me. When you see a news headline saying the RBI raised the repo rate, you should definitely pay attention. The repo rate is what the RBI charges to lend short-term funds to commercial banks. If the RBI wants to fight inflation, they raise it. Suddenly, it costs banks more to borrow from the RBI, so what do? They pass that cost right on to you by raising the interest rate on your car loan or your mortgage. Borrowing gets expensive, so people spend less. On the flip side, the reverse repo rate is what the RBI pays banks to park their excess cash. By tweaking just these two little levers, the central bank masterfully controls the daily liquidity of the entire country. So, how is this massive, complex machine adapting to handle modern crises? Let's take a look. Section 6, Reforms and the Future. For a long time, the RBI heavily micromanaged every tiny detail of banking. But the economic reforms of the 1990s showed we desperately needed more efficiency. So, we're seeing a massive paradigm shift. The RBI is transitioning from a strict regulator to more of a facilitator. Instead of acting like a strict headmaster hovering over every single internal decision, the RBI is stepping back to be the referee. They let the banks play the game, innovate, and compete globally while just making sure nobody breaks the core safety rules and capital requirements. But look, lending always involves risk. Sometimes borrowers just default, and those bad loans become non-performing assets, or NPAs. When a bank gets stuck with way too many of these toxic assets on its books, it freezes up. It literally stops lending to healthy businesses. To fix this, economic surveys recommend spinning off bad banks. You can think of a bad bank as a financial quarantine zone. You take all the toxic loans making a bank sick and you isolate them in a totally separate entity whose only job is to recover whatever value is left. Boom. The original bank's balance sheet is instantly cleaned up, and it's ready to start pumping fresh credit back into the economy. It is definitely a delicate balancing act. You have to empower the engines of credit while keeping the passengers safe. So, as India's economy evolves, is shifting the RBI from a strict regulator to a facilitator and spinning off these bad banks really the right formula for long-term stability? Will looser regulations spark incredible innovation, or are we just exposing ourselves to brand new systemic risks? As the economy rapidly expands, the mechanisms we've explored in this explainer, from Lala's fractional reserves all the way to the RBI's open market operations, are going to be put to the ultimate test. Thank you so much for joining me today. Keep questioning the systems around you, and I'll catch you on the next deep dive.